Hello, everyone, and welcome back to the second installment of these accounting basics videos. Today we're going to be talking about the cash method versus accrual method of accounting. Those are the two basic kinds of accounting for your books. And what that brings up then with the accrual method is something called the matching principle. We're going to go over that as well, okay? So let's start with the cash method of accounting. This is a lot simpler and basically just says that whenever cash changes hands, there is a transaction that gets recorded. Okay? So your profit and loss, remember that's the same as your income statement, same as statement of operations. It just basically details what your income was and what your expenses were. And then you either have a net income or a loss. So those transactions impact your income or expense whenever cash comes in or goes out. It's that simple. So where is this commonly used? The most common place is individuals' taxes, right? If you've ever pulled a W-2 paycheck from an employer, you get a paycheck and it gets recorded on that date, and at the end of the year you get a W-2 which shows the total amount that came in for that year. And that's what you pay tax on. If you happen to get a bonus, let's say, on January 1st for the prior year's work, and it's a big bonus, well, good for you. You're not going to pay taxes on it until the following year. Okay? Now, another common group, I guess you could call them, that uses this method is much smaller businesses, especially those that don't have any significant inventory, okay? Once you get into inventory, it starts getting a lot more complex, and you have to generally move over to the accrual counting, okay? So that brings us up to the accrual counting. Oh, I wanted to mention one more thing. So if you do use cash or accrual, you need to remember that however you keep your books is how you need to report your taxes. Because if you were, God forbid, ever to get audited, that's how you're going to show what you put on your tax statement, right? Okay, so now moving on to the accrual accounting. So this basically says two main things, okay? Revenue is recorded, or income, whatever you want to call it, sales, it's all the same. That's recorded whenever it's earned, okay? Not necessarily when you get paid, but when you earn it. Now, you might say that's kind of a vague word, but really just go with what it is. If you just use it in its simplest sense, that's the easiest way to make sense of it, okay? So if somebody pays me $10,000 today to work with them over the next 6 months, have I done anything for them yet? Not really, right? So all of that would not yet be revenue until I have performed the duties that are in the agreement between myself and my customer. And as I complete those, in this case, you could say it was as simple as, yep, it's going to take me exactly 6 months. I'm going to work about the same on it over those 6 months. Then you just recognize it evenly over the 6 months. Okay? Then your expenses, we already hit the top side of the P&L. The bottom side of the P&L, your expenses need to be matched with whatever the benefit is that they relate to. Okay? So that leads us right into the matching principle. That's what matching is. It says take your expenses and put them in the same period as the revenue or benefit that they relate to. Okay? So now let's just go over a few examples of matching, and I think that'll pretty much clear it up and make this video good, all right? Okay, so the first one is, let's talk about deferred revenue. Okay, that's the exact case that I just mentioned. If I get $10,000 today, let's make it easy. If I get $6,000 today, but I'm going to be working with a customer to complete the agreement that relates to over a 6-month period, then on the day that I get that check, it's in deferred revenue. Okay? And then each month, I'm going to move 1,000 of it from deferred revenue into revenue. Okay? And what that actually looks like on your balance sheet is you have a liability of deferred revenue because you got cash, but you haven't performed what the agreement says you will perform yet. So it's actually a liability to you. Okay? But then it'll go down and the revenue will come in over the course of performing the work and earning that revenue. Okay? Another easy example is talking about where costs of goods sold go. And that is wherever the revenue went that it relates to. Okay? Maybe an easy example of cost of goods sold is shipping. Let's say you have a product and you always have to ship it from wherever, your place or dropship, whatever it is. But when somebody buys this product from you, part of your expense is shipping it to them, and those should always be in the same period, right? You earned $100 for the product, but it cost you $5-10 to ship it. Match those in the same period. Okay? The last example I'll give is a little more complex, but maybe a lot of you have already heard of depreciation or amortization. This is kind of the other side of the coin from deferred revenue. So in deferred revenue, we had this balance that was a liability that we had to earn still. And as we earned the revenue, the liability went down. Depreciation and amortization has to do with having an asset on your books. Asset is usually thought of as good, right? But the asset could be capital asset, goodwill, intangible asset, all kinds of different things. But let's talk about the simplest one, capital asset. Okay? You buy a big machine for your business, whatever it is you do. Let's say you're a farmer and you buy a tractor. That tractor, the expense of, I don't know, 100 grand, 50 grand. I can't say that although my grandpa does own a farm, I can't say that I know exactly how much that stuff costs. But let's say you spend 50 grand on a tractor today. Well, that's going to benefit you for a long time, right? You're going to be using that tractor hopefully for 10 years, let's say. So the idea is you estimate how long that asset is going to benefit you, and you spread the depreciation across that period. Okay? So in this case, 50 grand over 10 years, I guess that means you'd have 5 grand hitting each year. Okay? So it's all kind of the same concept. Again, just think of wherever the benefit to my company hit, whatever period that was in, I need to somehow match the related expenses into that period, okay? Amortization of an intangible, although it sounds a lot more complex, it really isn't. So a common intangible asset is, let's say you're a business and you buy one of your competitors' businesses. Along with that, a very common benefit is a customer list, right? Now you have a lot of their customer contact info. So maybe you estimate that that's going to benefit your company for a year, 2 years, 3 years, whatever it is. You come up with a valid estimate and you say, this is how much this is worth to the company, and this is how long it's going to benefit us. That's an asset on your books, customer list, you call it. And then you slowly expense that over the period of the 3 years. Okay? So that does it for this video. Now, as a question, what could we come up with here? I guess I would like to know, have you heard of accrual before? Does it confuse you? Do you have any questions, I guess, about other instances where it might come up? And I guess any question will do. Please comment below if you have a comment, and I'll see you next time.